Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup. This is for the trading week ending March 6th. That would be March 2nd through March 6th last week. I'm Preston Brent. Thanks for tuning in. This week's theme, well, I just keep having this visual of a pack of squirrels trying to cross a four-lane highway. I'll get to that in just 1 minute. But we've seen the Dow, S&P, and NASDAQ actually finish into the green this week. I'm going to tell you in a minute some of the point swings, you would just assume that the markets all finished in the red. The only one that finished in the red for the week was the Russell. It was down about 2.14%. But all markets are in the red for the year. The Russell's leading the pack at the bottom, 13.14% year to date to the downside. So it is still in a correction territory. However, the Dow is at 9.37%. It's down for the year, and the S&P is down 8% for the year. NASDAQ's only down 4.42% for the year. Now, if we look at the world markets, everything was in the red this past week, everything. And if we look at the U.S. volatility, well, volatility actually, if I told you volatility ended a week ago at 40.11, and then it finished this week even higher at 41.91. That just shows you the tenacity. Generally, when volatility gets into the 40s, it's very difficult to hold that level. And that's what we've seen. And so it was up about 4.3%. And the sectors here in the U.S. that were the best performing sectors, there's only really a few, but the utility sector was up a whopping 7.9%, while energy was the worst performer, around 7.7% to the downside. Looking at the PE ratios, clearly they've come down. The trailing PE ratio is sitting around 23.86. The forward PE ratio for the earnings guidance, at least where it sits right now, is 17.42, but I think that number is going to come down even lower. But it is still lower by 27% from the trailing 12-month PE ratio. The annual dividend yield is still over 2%. 10-year interest rate, wow, is that low? It's down around a little over 1.1%, or I'm sorry, it's down. I think this past week we saw it come down even harder. I mean, if we look at interest rates, you can see the 10-year interest rates at 0.706, 70 basis points, huge move lower in what we've seen in the interest rate. So we've got to just kind of watch that very closely. But we just had almost a systematic shock, right, to the markets and to the interest rates as they moved lower this past week. Really amazing, 70.6 basis points. That's just amazing to me. So that's kind of where we stand right now. But this is the kind of market where you feel like if you could, you'd short sunshine and go long hurricanes. I mean, fear continues to grip these markets. We're in the third week now. This will be the third week coming up with the COVID-19 impact on the U.S. markets, and it really started around Feb 20. Now, this past week, like I said, if I would have told you the point swings that we've had, if I would have told you that this past week we had the Dow going down on one day 785 points, another day 969 points, and another day 256 points, and then were to ask you, did the Dow finish up or down for the week? Most people would say down. But we've also had 2 days, 2 up days of 1,293, almost 1,300 points, and then 1,173 points. So we did finish up for the week. Not a lot, but we did finish up for the week. Okay. Productivity, meanwhile, seems to be lifting just a little bit in China. So hopefully that will continue to wash its way through the pipeline through the rest of the Asian markets into Europe and in the U.S. But we're seeing the opposite effect still so far. South Korea, Japan, Iran, other countries in Europe like Italy, they're all getting more and more cases and more transmissions of the virus. Here in the U.S., we're also, as expected, seeing more cases as we start to test more people. I've heard terms like exogenous shock, black swan, royal flush, a whole number of terms, and they're all probably appropriate right now. The problem is the markets are having a hard time creating an accurate impact of revenue assumptions downstream. It's very difficult to do right now. Most are being dramatically lowered across all industry segments, especially things like travel and leisure and some of these other segments are just getting decimated. I personally believe it's going to get worse before it gets better. We got to be very careful. I think it's going to be um, with the nature of what I'm seeing in Europe. And remember, Europe was already a weak economy going into this COVID-19 problem. The U.S. was much, much stronger, but I still believe it's going to get worse. You know, and unlike the 2008 financial crisis, which was more, as I said last week, a balance sheet crisis, this is more a supply shock. You know, and we can see demand destruction here. It's more of a revenue kind of crisis where income is going to stop coming in from these companies because no one's going to be around to buy it because the companies can't get their products. The good news side of this longer term, I think you're going to see a lot of larger corporations start to shift and maneuver their supply chains and not be so heavily dependent on China. It's going to be bad for China, but I think longer term it'll be a good thing. And we already saw some of that during the trade war that Trump has still got ongoing right now with China, but I think that's going to be a good thing longer term. We've got consumers less willing to travel, spending affecting all these different segments of the industry right now. I think we're going to get future downgrades in revenues. And keep in mind, we're only about 5 or 6 weeks away from the Q1 earnings. Okay, now the U.S. economy, as I said earlier, is much stronger um, and better able to withstand this global shock than say Europe or even China for that matter. The jobs data came out this past Friday. It showed very strong consumer and a strong economy, wage growth higher, employment down to 3.5%. More than expected new jobs added with revisions to the upside in prior months. 273,000 this past month. Really amazing. I mean, just to me, amazing. Um, and a lot of this, though, is due to the ultra low interest rates we've had in the U.S. There's been tons of Fed stimulus here over the past dozen or so years, you know, getting us out of that balance sheet crisis that we had in '08 and liquidity crisis that a lot of that seemed to cause. But just understand over the past 5 years, corporate profits have not increased very much. In fact, last year they fell, yet the S&P over the same 5 years have moved up 60%. And you say, well, how the heck did that happen? And it's very simple when you've got low interest rates, PE multiples tend to go higher, but we're starting to reach that saturation point where any lower PE ratio is not going to result that much in a positive effect for the equity markets. All right, so we're going to see, I think, different types and forms of stimulus. It was already hinted by uh, um, the Trump administration this past Friday. I think Thursday or Friday, Larry Kudlow came on and they were talking about some fiscal stimulus, but more targeted stimulus, which makes sense to me. But we're going to see more of this, I suspect, coming up shortly. Also, next week, we got the ECB. They're going to be meeting. We're going to get their state of the economy. I suspect they're probably going to have more pressure on them to announce some more stimulus. We're going to see some coordinated stimulus also out of China and Japan. I'm pretty sure the feds are coordinating with all these central bankers and governments to see what they can do from a fiscal perspective, which I think would be better served than, say, monetary, which traditionally comes from the central banks. So that's kind of where we're floating right now, guys. What I'm going to do is I'm going to take you to a screen here. Let me just find this darn thing. I'm going to take you over to our screen of an Ichimoku chart. I'll let it paint on the screen here before I dive into it. But you're going to see I've got it on a 240-minute chart, which is a very good chart. And I think it kind of gives you an X-ray view. I like to say it's an X-ray view of the daily because the daily looks entirely different the way it kind of sets everything out. But you can see here on this Ichimoku that the this red cloud here, I'm calling it an R1 zone, right? So it's kind of an R1 zone, which is a resistance zone here. And you can see the width of this zone. And that's a lot due to the volatility and the movement of the price action. But until we get through and above this and get some positive energy back into the markets, we're still subject to a downside move. You can see also labeled as the 3-4, and then I'm suspecting an Elliott wave 5 on this chart, taking us somewhere down in this area here, which takes us around the 2800 to 2775 zone. Okay. And as I was telling all our members, and I probably told you guys too, and you could probably just tune in on any uh, business channel, and they're going to tell you the same thing. Beware of any bull trap. That was a bull trap. When we came back down here and we came back up to retest that area, that was like a double note that said, get out, get out. It's like a screaming get out kind of mode. So this 3120 is a key level here. You could see here it provided support for about 8 or 9 240-minute bars. So it's about 5 days, a little bit over a week, about a week roughly, 4 days, something like that. And then we could not get back up above it right here. And that was like, if you didn't get the sign right here, you clearly got the sign right here that you got to be like, okay, careful. And then you can see we rode this red zone all the way back down. We had a little bit of a bounce over the past couple of days, okay? And you could see that it was not enough. And I suspect any bounce here, especially if we go up a little bit, is probably going to be met by more selling. Seems like the markets want to test the lows, this pivot low that we made after the coronavirus hit, right? Towards the end of February, going into March, 28.53. Of course, you always have an overextension of any test generally, and that would give us this Elliott wave 5 down at this level down here around 2800 to 2775 roughly. So that's kind of what I'm saying is the near term. Now, also understand that even near term, we could come back up and get a little bit of a lift here. This is the key level for me right here on the upside, unless or until we can move over this and then I can see a test of that level and it holds. We're still going to be subject to sideways to downside chop. All right. And interspersed between all of this is going to be big moves up and big moves down. But the challenge wants to move down. You can see all of these lines that I have on the screen here. I got a bunch of them. The yellow dashed lines are key pivot levels, right? So here's a key pivot low right here. These other yellow lines here, dash yellow lines, were key pivots off the screen, but you can see where they've also provided support and resistance here as well, but they were developed off the screen, or created off the screen, if you will. The solid lines are technical indicators. These are Fibonacci nodes, okay? So you can see these Fibonacci nodes coming in here, and I've got these are fib extensions. This orange line right here was the September 2018 highs, and you can see that we kind of find our way around here just a little bit and we kind of blow through it a little bit. But these are extensions off those September highs from the pivot lows made in December 2018. So they're very solid levels. By the way, this level right here is about a 50% retracement from that pivot high and pivot low from December 18 to September or December 2017 to September 2018. This would be a 50% retracement right there. And we came almost right down to it and hit it. And now you can see back down at this level here, we start to come back down a little bit. Okay. So we've got to be very careful with these markets. But again, 3120 right up at this level here is what I'm going to be watching. I want to see us get elevation up, come back down, maybe retest it, and then come back up and take that prior pivot high out near term on the initial break. That will give the bulls a lot more confidence, a lot of algos, a lot more confidence. And then you can see us starting to bust a move through some of these key levels back up here. I think longer term, the markets are going to be higher than where they are now this year. That's how I would define it. The only caveat in that is if, and we don't know, but if the COVID-19 virus continues, probably another month and a half or 2 months, then we're going to start affecting Q2 earnings going into Q3. So that's not going to give us a fast recovery period, which means we're probably going to finish flat to, maybe up 3 or 4%. Okay. We can push the economy into a recession. I hear a lot of people talking about recession. It's probably about a 25% chance right now, looking at some of the Fed models, but we can push it over. And how can that happen? Well, if the consumer stops spending, because the companies are going to get all their goods back in and the consumer gets very scared, and it'll move us into a recession. But understand that the definition of a recession is 2 quarters in a row back to back below zero. It would take a lot to move the US into a recession right now. And also remember that you're in a recession before you know you're in a recession, because you're looking at data behind you, not in front of you. So we're going to get our first view of the Q1 GDP in April, early April. We'll get that, and that'll give us a good idea of just kind of where we stood. And remember, the Q1 GDP, it's going to give us a full 6 weeks of data, almost a month and a half, so half of Q1. So you're going to see market analysts, once we get those numbers, they're going to start doing their figures for Q2. Q2 will probably come in worse than Q1 because Q2 will get the full brunt downstream of the revenue cuts and so forth. But then it should start to return back to normalcy in Q3 and then full normal Q4. That's assuming COVID, is kind of backed off after another couple of months, okay, or month and a half or so. So that's what I'm seeing as I look through this at a high level, guys. I mean, there's really no other way to say it. If I come over, let me just switch the screen again, and I'm going to take you over to another S&P 500 E-mini futures chart. Let me just get this here like this. Let's come over here. This is a daily chart now, or a weekly chart rather, of the S&P, and you can see this huge red candle. As soon as it comes up on the screen, it's going to take a second to paint, I guess. So you can see this right here. Boom. It really just tore into it. This was the first indication up here, but this was the big move. Now look at that candle. I mean, that candle is not a very pretty candle. I mean, we hit a high up here like that around that 32 30 area actually. 31 23, 31 24, but we could not sustain it and we came back down. And you could see the tall hair on this candle, suggesting that any move higher is going to be forcibly shoved down. You can see at the pivot low there, right over here, we were down 16.02%. Okay. You can see the current price action has us down a little over 12%, 12.7%. Just to give you guys some context, a 20% move lower puts us in a bear market, and that puts us at 27.18. And I said the near-term low on an Elliott Wave 5 is around a 2770 to 2800. So that would put us, to me, a more believable move lower. Maybe not a bear, but we could just squeak into it in a cyclical fashion, not a secular bull. We would still be in a secular bull, but just near term, we could dip down there for a month or so before things settle out. So you've got to be very careful in any move higher in the markets. Just assume until we clear some of these key levels, it's a bull trap. All right, that's the way I would look at it. Now, if I come in here and let's just take this off the screen here. Let me just undo my pen. Let's put back on a daily chart. And if we look at the daily chart here, now this yellow line is a simple moving average, which is less sensitive than an exponential, but either way, notice how we're below the 200 EMA, okay? And notice the 50 EMA is well above. So we got, I think, a bit extended from where we should have been, all right? And you can see, though, just looking at these candles, this past week just really suggests tons of just up and down shock. Kind of let's move with the headlines. And let's bounce with the headlines. You can see how that movement just is really going forward in time. Now, the only stock that we did see the 200 EMA provide some support in is Nasdaq. If we come into Nasdaq here, let's just find it on my screen. Here we go, right here. You can see Nasdaq is over the 200 EMA. This is the top 100 companies in the Nasdaq futures. All right, and if we look at the composite index, which is everybody in the Nasdaq, you can see here where we're down here, and it provided support at the 200 EMA, and we're just sitting right now on this yellow line, which is the most volume that took place going back 150 days. So you can see we've kind of settled in right here on this one. We're below zero, but not by much. And you could just see the movement here, okay? If we look at the world index, you can see we're down here. Again, the all world index has just really gotten really decimated here. And if we look at emerging markets, same thing with emerging markets. we're decimated down here in the emerging markets as well. So it's just everything is just getting crushed if we look at this. Now, if we come over here and we look at some of the treasuries, and let's look at treasury bonds. I mean, bonds just had a blowout. I mean, just literally, look at this. I didn't even have a chance to rack it up here, but if I move this up like this and just kind of show where bonds went, it went up to $180, 180, over four handles, and we were up at one point, I think 5 or 6, just some astronomical. This was a lot of panic, a lot of money, but not only U.S. money, but money from other countries coming in and picking up our bonds. Okay, our 30-year interest rate now is down to 1.21%. The Totally amazing. I would be willing to come up here and look at maybe shorting, picking up some puts in TLT, because TLT is the same way. I mean, TLT follows the bond, and you could just look at this. If this isn't this candle, this if this is not a signal that we could come down here and close this gap over the next few weeks, I don't know what is, right? I mean, we could just come in here and just come right down into this area right down here, and boom, we're there, right? I mean, we're there. So it's almost like a spinning top or a doji, and an island doji where we're just all off by itself. And generally, these types of candlesticks promote a little bit more downside. So picking up a put or two, to me, just is a higher probability trade than looking for more upside in this thing. Okay. Now, if we look at the 10-year interest rate, look at this. This 10-year interest rate, I mean, I had to just move this thing way down like this. I mean, it's just insane. Same thing, but just on the opposite side here. It made a low, intraday low of 0.660 for the US 10-year, lowest on record. And we kind of started breaking lows on record once we get below 1.51, 1.4, and then we're down at this level down here. So I think he's going to have a hard time holding this level. But I mean, we didn't see these levels even during the financial crisis. It wasn't this low. But this is what the global markets are doing, because it's bringing money over into the U.S. Big time. Money's coming into the U.S. markets from Japan and Europe mostly. If we look at currencies, the dollar had a pretty ugly period of time here, right? So right on Feb 20, which is when the COVID virus hit, the dollar started coming down hard every day. Now, you would think the dollar is a flight to safety kind of thing, and you may be right, but remember, this is not the dollar, it's the dollar index. It's measured against some other basket of currencies. And the one that's really done very strong, but it's deceiving. Here's the euro. The euro has just been on a rocket ship up. And look at the European Union, low interest rates. The economy is not that good, and you may go, well, why is the euro here doing so strong? This is strictly an unwind of a massive carry trade that's been going on for the past year or so. So what they do is they short the euro, they take the money, and then they go out and they buy cheaper or higher interest rate type products in the currency market, and they hedge off that currency risk. But now to unwind that carry trade, this is what's happening. They're buying the euro and selling whatever currency that they're doing a carry trade in. It could be Russia, it could be I can't talk, Brazil, some of those higher interest rate countries, and it's just a trade that's happening right now. So and this may take a little bit longer to unwind. I told our members about this a week or so ago as to why the euro is getting stronger when the economy looks so bad. And if we look at Australia is, I mean, let's just step out a little bit. Speaking of currencies, I mean, let me go. Look at this, guys. Currencies trend. I mean, they really trend. That's why I like them. Because once you get into a trend, look at this regression channel. I mean, this thing has been trending since January 2018, and it's been nothing but lower highs, lower lows as we go down, generally over a longer period of time. I think it's going to start to bottom down here. All right, I just don't see the Australian dollar going much lower. What's really moved it off, it started moving up, and then what really moved it down right here, if we come into this year and we come down, you can see that the COVID virus hit right around this area here, and it really, it's going to go where China goes, really. And I think the near term, the odds favor a little bit more upside in the Australian dollar. Okay. And if we look at gold, let's take a look at gold here for a second. It is, we haven't seen these levels in quite some time. All right. You can see, in fact, let me just mark a new high this past week, uh, right here. So we made new highs in gold. Uh, and as long as interest rates stay low, gold's a bet, and it plays better with lower interest rates. So you could do gold miners, you could do GLD, or you could do gold futures, and you could see the 2020 low, but we're just moving much higher. We moved right through my target, and then the target is going to provide support for higher movement up. And there is no divergences here, so that would suggest any sell-off is going to be bought in the gold market. If we look at palladium, palladium's come down big time. All right, it got a little bit elevated up here, but there was no divergences here, so that's why I didn't really want to trade this, even though it's an Elliott wave 5 to the upside. All right, we just didn't have the divergence that I would have liked to have seen to give us a really great trade. And this is $100 a point. So for those of you who have larger portfolio sizes, you could risk maybe $4,000 or $5,000 to make $40,000 or $50,000 in a very short period of time. And I knew when this came out, when this would roll over, it would be very quick and furious. Okay. Now, if we look at another one that's just really, by the way, let's take a look at copper here. There's going to be a play in copper also. If we look at copper, we're coming back down and testing the lows that we made, the prior pivot lows here in China. Remember, China suffered, just take 2 weeks or 3 weeks and go back in time, and that's where China was, right? So they're about 3 weeks ahead of us, really, as far as they're suffering in their country, because this is where this disease started, or this virus started. So I do believe that eventually this thing is going to move back up strong. And the way to play this is Freeport-McMoRan. Freeport-McMoRan is finally broken and come back down through these levels down here. So it's back down around where I gave a long signal on October the 11th, 2019, to go long Freeport-McMoRan. And you could see it was a huge move, about a 40% gain. Now we're back down at these levels here, but notice there's no divergences, so I'm not ready yet. I still think we got some more downside here before it starts to turn higher. Okay, let's look at oil. It's got its own problems. Saudi Arabia has already come out and said that they've lowered their shipments to China by a total of 500,000 barrels a month. There's 500,000 less a month that China is buying. That's a lot. And so what we're seeing now is the destruction of the oil and gas market for the near term. Russia is also playing hardball. China wanted to come out and cut production. Russia said no. So, and Iran said, well, we're not going to cut if Russia's not going to cut, because they're afraid of losing market share. But Iran, they have no choice except for what they sneak through the tariffs and the bans. I've got a longer term correction move of oil down to the 35 zone right now. If we go much lower, I'm going to, and notice there's no divergences here right now, at least not yet, especially with this move lower. Picking up a call in oil, because when it moves back up, it'll move back up to that next target point around 48.26, would be a great trade, because I just think it's at some point it's gonna bounce up. Right, it's gonna move up. If we look at nat gas, check this out, guys. Nat gas is continuing to go lower. It's following our regression channel, but now it's on the outside, but it's come down much lower. At some point, nat gas is also going to be a buy to the upside. All right, so these are just a couple that I'm following very closely here. All right, so that's a little bit about what we're running on right now, everybody. I just wanted to give you guys a quick update. Members, I will see you this Sunday evening. If you're not a member, I highly encourage you to come in. We've been unsteady with these markets, most traders, but at least for what we're doing, we've been pretty close to calling where the market's going to move and how they're going to move and so forth. And you can participate in that process. All right, everybody, have a great weekend. Remember, most U.S. Citizens in most states move your clock forward an hour before you hit the sack Saturday night, and you'll wake up an hour earlier, I guess. All right, have a great weekend, everybody. Members, I'll see you this Sunday evening for our weekly market watch. Take care, folks. Ciao now.